Welcome to Iron Financial, the show where we forge stronger portfolios by stress testing the market's weakest links. Today, we are putting BOX, ticker symbol BOX, squarely on the anvil. Now, here's the situation. The company just came out with earnings that absolutely crushed expectations, a real knockout punch. But if you look at its stock chart, well, it's a complete and total disaster. This, right here, is the kind of massive disconnect that can either make or break a portfolio. So our mission today is simple. We're going to hammer out the facts, piece by piece, and figure out if BOX is a structurally flawed investment that's cracking under pressure, or if it's a bedrock opportunity that the rest of the market is completely ignoring. Let's get to it.
All right, let's start with the numbers, because in this business, the numbers are where the truth always begins. You can't argue with them. For its fourth quarter, BOX reported adjusted earnings per share of 49 cents. Now, the so-called experts on Wall Street, the consensus estimate, was for 23 cents. You do the math on that, that is a 113% beat. Let me say that again, 113%. In a market that surgically dissects every single penny of a company's earnings, BOX didn't just step over the bar, they strapped on a jetpack and launched themselves over it. This isn't just a good number, it's an explosive result that should, by all rights, act like pure rocket fuel for a stock. It signals deep, fundamental operational strength and an almost extreme level of financial discipline. This is a number that screams competence from the rooftops.
Okay, rocket fuel is a nice thought, but in the real world, the market's response has been, well, a brutal, freezing cold shoulder. While the management team was probably high-fiving and popping champagne corks over that huge earnings beat, any long-term investor in this company was staring at their screen, nursing a nearly 30% loss over the past 12 months. Just let that sink in for a second. A company beats earnings expectations by over 100%, and their reward is a 28.5% haircut on their stock price. This isn't just a little bit of a lack of enthusiasm, lead analyst. This is an active, painful, and very loud rejection by the market. The press release tells one story, a very happy story, but the brokerage accounts of real people are telling a much, much uglier one.
And that right there sets up our central conflict perfectly. On one side of the scale, you have absolutely pristine financial execution, numbers that are almost impossible to argue with. And on the other side, you have a stock that's been thrown in the gutter and left for dead. This is the core mystery we are going to deconstruct for you today. Is the market seeing some kind of fatal flaw deep in the foundation that this shiny earnings report is somehow hiding? Or is the market so completely obsessed with chasing hype and the next big thing that it's ignoring a fundamentally strong structure being offered at a steep discount? This is where the real work begins. We're going to put this company on the anvil and we are going to see what it's truly made of.
So here is our battle plan for today. First, we're going to dig into this beatdown that happened right after the beat. Then, we'll get to work forging the bull case, piece by piece, using nothing but the raw data.
And after you build it up, I'm going to have to come in and stress test the AI story, the one that's supposed to be the entire future of this company.
Exactly. From there, we'll inspect the balance sheet, because that's the bedrock of any sound investment. And finally, after all that, we'll weigh all the evidence and deliver our final verdict. Let's dig in.
Okay, so let's tackle that first question. Why the beatdown after the beat? You have to remember, the market is supposed to be a forward-looking machine. It doesn't really care about what you did last quarter, it cares about what you're going to do for the next 5 years. So it seems to be completely ignoring BOX's stellar Q4 performance and is instead pricing in a future that it clearly really doesn't like. And this giant chasm, this disconnect between the past performance and the future price, is exactly where our analysis has to begin.
All right, now let's do something that can be very difficult for investors. Let's tune out the noise from the stock chart for just a moment. A falling stock price does not always mean a failing company. Sometimes it means there's an opportunity. So it's time to forge the bull case, using nothing but the hard, cold, undeniable financial metrics. The market can be emotional, it can be irrational, but the numbers, well, the numbers don't lie.
Now, what's so critical to understand here is that the massive 113 beat in Q4 wasn't some fluke. It wasn't a one-time miracle. It is actually part of a very clear and very consistent pattern of operational excellence. Just look at the data we have up here. Quarter after quarter after quarter, BOX delivers more profit than Wall Street thinks is possible. In Q3, they beat by nearly 50%. In Q2, they more than doubled the estimate. Look, this isn't luck. This is the signature of a management team that understands its business inside and out, knows how to manage its costs down to the penny, and consistently over-delivers on its promises. This pattern is the very first pillar you look for in any strong bull case: proven, repeatable, undeniable execution.
And you have to make sure that earnings beat wasn't just some accounting trick or a one-time cost cut. You need to see that it was built on a solid top line. And it was. The company pulled in nearly $306 million in revenue for the fourth quarter. Now, not only did this top the consensus estimates, but it also represents steady, reliable growth from the same period last year. No, it's not the hypergrowth you see from some high-flying startup, but it's predictable, stable growth on the top line. And that's exactly the kind of structural support you want to see underneath a massive earnings outperformance. It tells you the revenue engine is still churning away reliably.
And this chart right here, this brilliantly illustrates the real story under the hood. It's not just about growing revenue anymore. It's about growing profits even faster. Their non-GAAP operating margin expanded from 27.3% to 30.6% year over year. For those of you who track this stuff, that's a 330 basis point improvement. In plain English, what that means is, for every single dollar of revenue that comes in the door, more and more of it is dropping straight to the bottom line as pure profit. The company is getting more efficient, it's getting more streamlined, and it is getting more profitable with every passing quarter. This is the second critical pillar of the bull case, increasing profitability and what we call operational leverage. They're doing more with less.
This number, 1.7 billion, this is all about the future. This represents Box's remaining performance obligations, or what insiders call RPO. In simple terms, it's the total value of all the contracted services that they haven't yet been able to recognize as revenue. At $1.7 billion, and up a very, very healthy 17% year over year, this represents a massive backlog of locked-in future business. This isn't a forecast, it's not a guess. This is contractually obligated revenue that is just waiting to hit the books in the coming quarters. It provides incredible visibility into the company's future health. So let's recap the bull case so far. A long history of beating earnings, currently expanding profitability, and a huge backlog of future sales. The foundation here looks solid as a rock.
Okay, hold on a second. The foundation looks solid, I get it, the numbers are good, but if the numbers are so fantastic, past, present, and this future backlog, then you have to answer the question, why is the stock down nearly 30%? The market doesn't pay for the past, it pays for the future, and it only cares about one thing, the next growth engine. For Box, that entire story is all about AI. So let's stop admiring the concrete foundation for a minute and start stress testing this AI hype. Is it a legitimate new pillar that can support future growth, or is it just a fresh coat of paint on a tired old building that's about to be condemned?
So here's the narrative, and this comes straight from the top. The CEO, Aaron Levie, he's calling fiscal 2026 a defining year, all because of AI. What he's trying to do is reframe the entire company's identity around this new offering called Enterprise Advanced. He's essentially telling the market, hey, we are no longer just a cloud storage locker where you dump your files. No. We are now an intelligent content management platform. This is the official hype. And the question that every investor has to ask is this a genuine transformation that is going to re-accelerate growth, or is it just a really good story designed to attract a new class of investors who are chasing AI buzzwords? The stock chart seems to suggest the market is deeply, deeply skeptical. And, the story gets even more elaborate, even more abstract when you dig into it. The company's chief operating officer starts talking about creating hero agents. I mean, what does that even mean? This is supposed to represent the next generation of AI products, but what does it actually mean for revenue and profit? Is this a tangible product with a clear price tag that customers are actually lining up to buy right now? Or is it just aspirational marketing jargon that sounds good in an investor presentation? The market hates ambiguity. It hates jargon. When it hears terms like hero agents, it doesn't want to see a press release. It wants to see a purchase order. And right now, this sounds a lot more like a concept than a proven money-making product.
So this right here is the absolute heart of the bear case. Is this a legitimate, powerful pivot into a high-growth, AI-powered future? Or is this just AI washing? That's the term for when a mature, slower growth company just sprinkles AI buzzwords all over its investor presentations to try and trick the market into giving it a higher valuation. The market seems to believe it's the latter. The brutal stock performance we've seen suggests that investors are hearing the AI story, they're looking at the single-digit revenue growth, and they're concluding that it's just a new coat of paint on a business whose best growth days are long, long gone.
And here it is. This is the single data point that gives the bears all the ammunition they need to make their case. The entire AI narrative, this whole defining year that the CEO is so excited about, is currently tied to this one offering, Enterprise Advanced. And according to the company's own numbers, that offering only accounts for 10% of total revenue. Just think about that for a second. The entire future growth story, the whole hero agents pitch, is resting on a tiny little slice of the business that makes up only 10% of the pie. The other 90%? That's the mature, slow-growth legacy business.
The market is looking at this and saying, this tail is far, far too small to wag this very large dog. It's just not big enough to matter yet.
That is a perfectly valid criticism. I'm not going to argue that. The AI story is in its very early innings, and it is absolutely a show-me story for the market. But you cannot assess the potential of that little 10% slice in a vacuum. The most important factor, the one that everyone seems to be ignoring, is whether the company has the financial strength to actually fund that growth, to turn that 10% into 20%, then 30%, then 40%. You see, a startup has to go out and raise money to fund its dreams. Box doesn't. It can fund its own future. So, let's get back to the bedrock, the balance sheet and the cash flow statement.
This right here, this is the engine room. In the fourth quarter alone, Box generated over $110 million in cash just from its operations. This isn't debt. This isn't from selling more stock and diluting shareholders. This is the pure, unadulterated cash profit that is being spun off by that core 90% of the business. This cash is the fuel that pays for the engineers who are building those hero agents. This is the money that funds the sales team that's out there pushing the Enterprise Advanced platform. A strong, consistent cash flow like this gives a company immense strategic flexibility. It allows them to invest heavily in their future without ever having to ask Wall Street for permission.
And if you have any doubt about management's conviction in their own story, you need to consider this. In a single quarter, they spent $126 million buying back their own stock. This is the ultimate sign of internal confidence. They are literally taking that massive cash flow they generate and they are telling the world, our stock right now at these prices is the single best investment we can possibly make. They aren't just telling you the AI story is real, they are backing it up with their own cash, buying their own shares hand over fist. This is management putting its money where its mouth is, loud and clear.
All right, so the lines in the sand are now clearly drawn. On one side, I'm pointing to a fortress-like financial position. You've got consistent execution, expanding margins, a huge backlog of business, and a torrent of cash flow that's being used to buy back what management clearly believes are deeply undervalued shares. And on the other side, I'm pointing to a story that the market absolutely refuses to believe, with sluggish overall growth and an AI narrative that is, frankly, still just a tiny piece of the puzzle. So to make our final verdict, we have to look at the company's own blueprint for the future, their forward-looking guidance.
At first glance, the company's guidance for the next fiscal year, 2027, it looks pretty bullish. They're guiding to beat Wall Street's expectations on both the top line and the bottom line, on revenue and earnings. They are signaling continued stability and, more importantly, continued profitability. But, and this is a big but, here's the catch. The implied revenue growth in that guidance is only about 8 to 9%. Now, for a company that is pitching a grand AI transformation, that number is a massive red flag for the market. It feeds right into my narrative that Box is a value story, not a growth story. And in today's market, 8% growth just isn't exciting enough to get people's attention.
So, let's crystallize this entire debate. The bull case is built on a bedrock of pure financial strength. You have consistent, massive earnings beats. You have steadily expanding margins. You have a $1.7 billion backlog in RPO that guarantees future revenue. The company is gushing free cash flow, and management is betting on itself with aggressive buybacks. If you're a bull, you're buying a fortress.
And the bear case is all about that terrible stock chart, which shows a complete and total lack of faith from the market. The revenue growth rate is slowing down, and it's unimpressive. And the AI story, the thing that's supposed to save them, is still totally unproven and only accounts for 10% of the business. The market is screaming, great foundation, sure, but there's no growth, and we simply don't believe your blueprint for the future.
And this, right here, brings us to the absolute heart of the matter. There's really no debate about the company's current financial health. Its foundation is made of granite. The entire debate, the entire argument, is about price. The market has looked at the single-digit growth, it's looked at the fledgling AI story, and it has priced this company for a future of slow, steady, and ultimately very unexciting performance. The price you pay for the stock today assumes almost zero success from its big AI ambitions. It's priced for failure.
And that is the question we have to leave you with today. You, as an investor, have a choice to make. You can side with the market's overwhelming pessimism, focusing on that slow growth and the unproven AI narrative. Or you can side with the company's balance sheet, its gusher of cash flow, and a management team that is buying its own stock as fast as it possibly can. The financial bedrock is clearly there. The framework for the AI story is being built right now. The question is the market, in its endless, frantic search for the next shiny object, completely wrong about Box? That is a decision for you to make. Deconstructing these kinds of intense conflicts between price and value is exactly what we do here at Iron Financial. We believe a stronger portfolio is forged by asking the tough questions and trusting the data over the popular narrative. Thanks for joining us.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.